ETF investing seems easy. Just pick a few low-cost funds and you're set, right? If only. Too many investors are making totally avoidable ETF mistakes that are secretly draining their returns. Today, I'm going to pull back the curtains on the most common errors and, more importantly, reveal the biggest ETF mistake investors make so you can sidestep it completely and keep more of your hard-earned cash. Stick around. Seriously, stick around, because the last mistake we cover could be costing you thousands without you even realizing it. You're going to want to hear about this. Let's kick things off with ETF overlap. Now, I see this all the time. Investors think that owning more ETFs automatically means more diversification. And while this sounds logical, it's often a total myth. Here is a prime example. If you own both VU and QQQM, guess what? They have a whopping 46% overlap. That means that nearly half of your investments are actually in the exact same companies. Talk about redundant. You're basically paying double for the same slice of the pie. Imagine buying 2 bags of chips, but they both have the same chips inside. That's what you're doing. It dilutes your true diversification. Instead of spreading your risk across different industries, you are piling it into the same few giants. Fees, 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 fees. If you're not careful, you are paying management fees on assets you already own in another fund. That adds up. Now, overlap isn't always bad. Sometimes it's part of a smart strategic tilt in your portfolio. But if you're just blindly stacking ETFs without a clue what's inside them, you are essentially paying extra fees for less actual diversification. Don't be that investor. Up next, let's tackle a super popular approach that often leads to, well, mediocre results: the 3-fund portfolio. It sounds incredibly smart on paper: US stocks, international stocks, and bonds. And it can be, but in practice, I've seen it water down returns more often than not. Are you actually getting bang for your bucks? Let's be honest, over the past decade, funds like VX, US, and BND have often been the slow and steady tortoise, while something like VU was the hare. Don't let safety come at the cost of growth. If you are heavily weighted in VX US or BND, hoping for safety and stability, you might be diluting your portfolio's long-term growth potential significantly. It's about smart allocation, not just any allocation. Your goal is growth, not just being diversified for diversification's sake. So while the 3-fund portfolio has its merit, make sure you're not sacrificing explosive growth for a safe option that just isn't pulling its weight in your portfolio. It's about being strategic. Mistake number 3. All right, it's confession time. Ever hear about some hot new ETF blowing up and think, oh man, I have to buy that? We've all been there. It's that classic fear of missing out. But jumping on every single trend without a solid plan is a recipe for a bloated, messy, and ultimately underperforming portfolio. Your portfolio becomes a Frankenstein monster. You end up with a hodgepodge of random funds bought at peak prices, all because of a TikTok video or Reddit thread. High fees and heavy overlap lurks. Those trendy niche ETFs often come with higher expense ratios and, surprise, surprise, can still overlap with your core holdings. Remember, buy high, sell low isn't a strategy. Chasing trends often means you are buying after the biggest gains have already happened, leaving you holding the bag when the trend inevitably cools. I once spoke to an investor who owned 12 different ETFs, many with overlapping holdings, ridiculous expense ratios, and absolutely no clear strategy. It isn't a portfolio, it's just a patchwork of fear and FOMO. Don't let that be you. Mistake 4. Yield versus growth. Here is a common tug of war. Some investors go all in chasing high dividend ETF, wanting that sweet, sweet cash flow. Others focus solely on high-flying growth stocks. But here's the kicker. If you completely ignore one or the other, you're likely leaving serious money on the table. High yield doesn't always mean high returns. Those juicy dividends might be nice, but often high-yield ETFs can seriously lag in actual price appreciation, meaning your principal isn't growing. Pure growth can leave you without income. On the flip side, super growth-focused funds might not pay dividend at all, which can be tough if you're looking for some income in your portfolio. So find your investing Goldilocks zone. The sweet spot isn't about choosing one or the other. It's about a balanced approach that gives you both consistent cash flow and strong capital growth. It's like having your cake and eating it too. Okay, now that we have talked about what not to do, let's talk about what to do. Here is a simple portfolio I often recommend for a balanced, long-term strategy that avoids all those pitfalls we've just discussed. 45 to 50% in Vanguard S&P 500 ETF. This is your rock-solid core, giving you exposure to the biggest, most stable US companies. It's the market workhorse. 30% in SCHD, the Schwab US Dividend Equity ETF. This bad boy focuses on dividend-paying, high-quality stocks. Think of it as getting paid while your money grows. I'm talking passive income. 15 to 20% can be in QQQM. That's the Invesco NASDAQ 100 ETF. This gives you a fantastic boost of exposure to cutting-edge tech and high-growth innovators. It's where the future happens. And then 5 to 10% can be in the Vanguard Real Estate ETF, VNQ. Want to get into real estate without being a landlord? This adds real asset exposure through REITs, diversifying your portfolio beyond just stocks. So why does this setup work so well? Because it's specifically designed to dodge those common mistakes. Overlap is intentional and measured. You're not just buying duplicates. You know exactly why each fund is there. Diversification is smart, not excessive. You are spreading your risk where it counts, not just for the sake of it. It's built for long-term, not short-term trends. No more FOMO-fueled purchases. And it brilliantly balances both growth and income, the best of both worlds. But let's get to the absolute biggest, most detrimental ETF mistake you can make. This one could seriously derail your financial future, and that is blindly copying someone else's portfolio. Your goals are your goals. What works for a 20-something-year-old trying to get rich quick is not what's right for someone saving for retirement in their 50s. Risk tolerance is personal. Someone else's aggressive portfolio might give you sleepless nights. So don't let someone else's comfort zone dictate yours. Know your why. If you don't understand why you are in a specific fund, you are already at a huge disadvantage. You are just gambling, not investing. Think about it. Your financial journey is unique. Your portfolio needs to be tailored to you, your dreams, your timeline, your comfort with risk. Don't just copy-paste someone else's strategy into your life. All right, so if you've already made some of these mistakes, don't panic. It's never too late to course correct. Here's how to whip your portfolio into shape. Analyze your ETFs. Look beyond the ticker symbol. Check their actual holdings, their expense ratios, any hidden overlaps. You need to be the detective. Cut the underperformers without mercy. Don't let emotionally attached poor funds drag down your entire portfolio. If it's not serving your goal, it's time to say goodbye. Pick purpose-driven ETFs. Be intentional. Some for broad market exposure, some specifically for growth, some for income, and yes, some for those awesome real estate assets. Every fund needs a job. And then be consistent. Automation is your friend. Stick to your chosen strategy. Set up automatic contribution and rebalance periodically as needed. Discipline beats guesswork every single time. Look, ETFs are incredibly powerful tools. They can truly accelerate your wealth journey, but only if you use them wisely. The goal here isn't to be perfect, but to build a portfolio that truly reflects your goals, not someone else's highlight reels. Avoid these common mistakes. Invest with purpose, and I promise you, your future self will be sending you thank you notes. If you found this video helpful, do me a huge favor. Smash that like button right now so YouTube knows to share this with more amazing people like you. And of course, don't forget to subscribe for more no-nonsense investment insights. Oh, and drop a comment below with your current ETF strategy. I'd absolutely love to hear what you are building. Until next time, stay financially savvy. I'll see you in the next one.